leverage. So we are going to see the topic under DT based delivery method. So today we are going to discuss this topic under the problem based method. That is, we have taken this topic and we are going to make use of some problems to make you understand clearly. Okay? So when we talk about the leverage is how one variable influences the other variable. So in leverage, we will see the various variables like sales, variable cost, fixed cost, and we will also see interest. So how these variables influencing your earnings is what called as a leverage. So leverage in the sense how one variable influences your earnings. So if your leverage is higher, the risk is high. If the leverage is less, risk is less.
Good morning everyone. I am Isma from First Agri. Today I am going to explain about the design thinking approaches for types of leverages. The first step is empathize, which means understanding the problem the student faces while learning the operating leverages concept. In this case, the students may confuse by getting difference between the operating leverages and financial leverages. Operating leverages is related to fixed operating costs like rent, salaries and other production expenses, and the operating and the financial leverages is related to the debt and other debentures part. So the students are often getting confused between and they are struggling to link the real-time examples of leverages with the real-world examples. Thank you.
Good morning. I am Dhananjay. I want to explain first one is there are three types of leverage: operating leverage, financial leverage, and combined leverage. Operating leverage, use a manufacturing company versus a service company comparison. It shows how high fixed cost affects profit and when the sales also change. Financial leverage, there are two compare of flips, one using only debt finance, another one is using equity only. If the debt increase, the risk also increase. Next one is the combined leverage, ID both cost structure and financial decision making. Use scenarios where both the sales and debt leverage levels are changed into profit.
Good morning. Here we use the problem-based method. Today in this problem we have to calculate operating leverage, financial leverage and also combined leverage. The givens are sales 50,000, variable cost also given. We have to minus sales and variable cost. We will give 25,000. It's called contribution. In contribution it will minus fixed cost. It's 15,000. We will get EBIT. It's 10,000. In EBIT it will minus interest. It's 5,000. We will get EBT. It's this EBT 5,000. In operating leverage, the formula is contribution divided by EBIT. Contribution is 25,000 and EBIT is 10,000. So answer is 2.5 times. Financial leverage formula is EBIT divided by EBT. EBIT is 10,000 divided by 5,000. It's equal to 2 times. Combined leverage, we have to multiply operating leverage into financial leverage. 2.5 into 2 is equal to 5 times.
Good morning. I am Dr. I am going to discuss about the outcomes of design thinking approach. We can clearly differentiate the three types of leverage. First one is operating leverage, financial leverage, and then final one is combined leverage. The first one is financial leverage. It shows the financial risk of the firm. The operating leverage shows the business risk of the firm. And the final one is combined leverage. It shows the both financial and operating leverage. It is the total risk of the firm. These leverage concept we can apply in the real life problems to make a proper decision making, financial decision making.
So coming to the conclusion, students, in today's session we were discussing on the various types of leverage. So what are the types of leverage we have seen in today's class? Operating leverage, financial leverage and combined leverage. So operating leverage, it measures the risk of the company. That is, it mainly measures the business risk of the company. That is, how your fixed cost is influencing your income. That is what called as an operating leverage. So when your fixed cost is increasing, obviously your earnings will your earnings, that is not called as a financial leverage. Combined leverage in the sense, right from your sales, how the earnings it influences, it is called as a combined leverage or composite leverage. So overall leverage, it measures the risk factor of a company. So always the risk, it should be less so that the return of the company will be higher.